person died, the exclusion amount dropped to 1 million.
Okay.
What they will do?
Okay.
They will recapture.
Very good questions. No, very good questions. Okay. Say for rich person, eventually in Silicon Valley, this is the average. Okay, I believe for the average family, they may have $5 million. So say for 2012 this year, they want to fully utilize this high amount, right? Say $5 million. So they just transfer $5 million in 2012, and also they legally report this transfer in 2013. So they will report, okay, in 2012, I did transfer $5 million assets, say the home, whatsoever, to my children. And that means they fully use up their total exclusion already. And then a few years later, A passed away. In the year A passed away, the exclusion already dropped to $1 million. No more $5 million. Hopefully they will not happen, but in case they happen, and her question is, does A need to pay back $4 million gift as a tax? It's called recapture. Every time you want to pay back something, it's called recapture. And my understanding is no, you don't have to. You don't have to. Okay, this is it. And there's the law. If you need to recapture, they make the whole thing for 2012 meaningless. They make this $5 million totally void, right? So that's why for rich family, they are so hurry to fully utilize this $5 million exclusion for this year. All right. So if the year later A died and then the exclusion dropped to $1 million, number one, A does not need to recapture anything. However, the sad thing is, whatever left under A's name, all subject to state tax. And state tax is not cheap. State tax is between 35% to 45%, sometimes more than 50%. It's not cheap. So it's more like another penalty to very, very rich family. All right. And then, if A really want to avoid, A really like Warren Buffett, Bill Gates, people like those very, very tier one rich family, and then the last vehicle is 501c3. Is sometimes some people say could be the family foundation. Family foundation. All right. Because A does not want to leave anything too much to give to IRS, right? Because you know, once A passes away, whatsoever A cannot control anything, right? But only one thing A still can control. The only thing, one thing A still can control is A does not IRS to take over the money. The money, even though A cannot control, but A say, okay, I cannot control it, but I don't want IRS to control it. And the solution for that is to set up the 501c3 organization, and is the people say family foundation. If you watch the PBS, public, it's PBS, right? Public, what's the name of the PBS? The TV channel, right? Right, PBS. And every program, by the end of the program, you see this program is sponsored by Rockefeller Foundation, Ford Foundation, such and such, right? Right. They are family foundation, they are. For very, very rich family, the final solution for the assets, and you want to avoid double tax. You really want to avoid, because you know those monies been taxed already. Those assets have been taxed during the lifetime. Every year people pay income tax already. Why do you need to pay twice again? By the time even as a gift or as inheritance, right? So the very last solution for this is to set out the family foundation.